You ever notice how some people seem to glide through tax season like they've been handed the cheat codes to the American financial system, while the rest of us are stuck digging through receipts, praying nothing was missed, and hoping the IRS doesn't send a letter with that terrifying bold print? What if I told you that the difference between the overwhelmed taxpayer and the calm, confident high earner isn't about income alone, and it isn't because they have some superhuman organizational skills? The difference is something much simpler. They know things you were never taught, not in school, not in your job, and believe it or not always by your accountant. That's the part that catches most people off guard, because you'd think hiring a professional means they tell you everything you need to know. But that's not how the tax world works. Many accountants are focused on compliance, getting your numbers in the right boxes and keeping you out of trouble. High earners, they focus on strategy, and strategy operates in a different universe than basic filing. It's the difference between playing checkers and playing chess. Both use a board, both follow rules, but only one lets you see 5 moves ahead. Before we go any further, here's the quick disclaimer. This video is for educational purposes only and is not financial advice. Always speak to a qualified professional who understands your specific situation. Now let's get into the mindset of wealthy Americans, the people who treat taxes not as an annual headache, but as a system to be understood, navigated, and optimized. Because the truth is, the tax code isn't written to be fair. It's written to guide behavior. And the people who understand that reality are the ones who legally pay less, build more, and stress less. And it starts with understanding a counterintuitive truth. Accountants are reactive, wealthy people are proactive. Most Americans see their accountant once a year, usually in a panic, hand over a folder and hope for the best. But high-income earners treat taxes as a year-round project. Why? Because the biggest tax savings don't happen in March or April. They're created in July, in October, in random conversations at dinner when someone says, there's actually a more efficient way to structure that. This is the first tax secret your accountant might not tell you. Your tax return tells the story of decisions you made 12 months ago. Once the year ends, the story is already written. All your accountant can do is report it. They can't rewrite it. And wealthy people understand this deeply. They know tax planning isn't paperwork, it's strategy. And one of the first strategic mindset shifts is understanding that the government doesn't reward you for making more money. It rewards you for how you make money. This leads us into the next secret high earners live by. The tax code is built around incentives, and incentives are like hidden doors. If you know where to look, they're everywhere. One of the most overlooked incentives is the power of structuring your work as a business instead of an individual filer. This is why so many wealthy people form LLCs, S corporations, or partnerships even when they're not running massive companies. They understand that the moment you switch from individual filer to business owner, the tax code starts treating you differently. For everyday taxpayers, the options are limited. Standard deduction, maybe itemizing if you're lucky, a couple of credits, or retirement contribution. But for businesses, suddenly you're allowed to deduct things the tax code considers legitimate business expenses. Expenses that might look identical to things you're already paying for as an individual. Your phone bill? Possible business expense. Your home office? Deductible. Your internet? Deductible. Your travel? Deductible if tied to business. Your meals? Deductible up to a percentage. Your equipment? Deductible. Your continuing education? Deductible. Here's the subtle part most accountants don't emphasize. These aren't loopholes, they're features. They exist because the government wants to support business creation. High earners know that the moment you have even a small side business, the tax code shifts from being your opponent to your partner. But here's an even deeper secret. Wealthy people don't just create businesses, they create entities that strategically work together. This is a concept accountants rarely bring up because it's outside basic filing. They're not required to teach you strategy unless you specifically pay for it. Think of it like this. A high earner may have an S corp for their consulting work, a separate LLC holding intellectual property, a partnership tied to real estate, and a trust holding long-term assets. Each entity has a purpose. Each interacts with the tax code in specific ways, and each unlocks tax options the average individual never even hears about.
Now let's shift to another secret. Tax savings are often hidden in the timing, not the dollar amount. Wealthy people know how to shift income, shift deductions, and shift recognition events. Your accountant might only think in terms of the year at hand, but wealthy people think in terms of multi-year tax arcs. For example, a high earner knows that sometimes the smartest move isn't reducing income, it's moving income into a year where they'll fall into a lower bracket, or pushing deductions into a year where they'll have unusually high taxable income, or recognizing investment losses at the exact moment those losses can offset gains. Timing is everything in taxes, but your accountant only sees what happened. Wealthy people look at what could happen. Let's talk about something else accountants rarely push: the tax advantage of controlled spending. Wealthy people use pre-tax dollars wherever possible to fund things they'd be paying for anyway. Let's take retirement accounts as an example. Most people know about a traditional IRA or a 401k, but high-income earners use solo 401ks, SEP IRAs, defined benefit plans, mega backdoor Roths, HSAs, cash balance plans. Some of these allow contributions of $50,000, $100,000, even over $200,000 depending on income and structure. That means they're sheltering income from taxes today, reducing taxable income dramatically. Most accountants may remind you to max out your IRA, but they often don't stop to ask, should you restructure your business so you qualify for a much larger retirement plan? Wealthy Americans know the answer is often yes. Another secret: wealthy people take tax credits seriously. Most taxpayers get excited over a $300 credit, maybe a child credit or an education credit. High earners use credits designed for investments, for energy, for hiring, for research, for development, and for real estate rehabilitation. Some credits are so powerful that smart investors build entire strategies around them. For example, certain energy credits can offset not just income tax, but sometimes alternative minimum tax as well. Some real estate credits allow dollar-for-dollar reductions that can wipe out huge chunks of liability. A lot of accountants don't bring these up because they assume the average client either doesn't qualify or wouldn't be interested. Wealthy people, they actively look for them. That brings us to the next major secret. The tax code treats assets differently based on how they generate income, and wealthy people play in the right categories. Most Americans earn active income. Wealthy individuals focus on leveraged, tax-advantaged, or depreciated income. Depreciation is one of the most misunderstood tools in the tax world. Many accountants list it on your return, but they rarely explain what it really is: a non-cash deduction. It's money you don't actually spend, yet it reduces your taxable income. Real estate investors know how powerful this is. You could make $100,000 in rental income, but end up showing a loss on paper because depreciation cancels it out. High earners often use cost segregation studies to accelerate depreciation even faster. Most everyday taxpayers never hear those words: accelerated depreciation. High earners hear it often. Let's open another door most accountants never proactively discuss: the legal use of debt as a tax strategy. This is a signature move among high net worth Americans. They understand that debt, when used intentionally, can be more tax efficient than income. Why? Because income is taxed, but a loan, it's not income. It's not taxed. It's a tool. Wealthy people borrow against assets like stocks and real estate to access liquidity without creating a taxable event. Instead of selling an investment and paying capital gains, they borrow against it, keep the investment growing, and use the borrowed funds for major purchases, investments, or strategic moves. A lot of accountants avoid diving deeply into debt strategy because it's outside the scope of traditional tax prep. But for the wealthy, borrowing is a quiet power move.
And now we reach one of the most shocking secrets high earners understand, one that rarely comes up unless you're working with a tax strategist instead of just a preparer. Wealthy Americans build wealth and assets that the tax code allows them to pass down at reduced or zero tax. Whether it's trusts, step-up in basis, or exempt structures, high earners think generationally. They aim to preserve wealth, not just grow it. You see, most people think taxes are something you pay once a year. Wealthy people see taxes as part of a long-term game, one that continues beyond their lifetime. What makes this even more fascinating is that high-income earners don't stumble into these advantages. They learn them, or they pay people who understand them at a deeper level than traditional accountants. Because while accountants prepare taxes, strategists shape them, and wealthy people know the difference. This brings us to a truth many Americans never hear spelled out. The tax system was built for people who participate in the economy as creators, builders, and investors, not just employees. The more value you create, the more the tax code rewards you. And wealthy people build their lives around this fundamental reality. One thing you'll notice if you ever spend time around high earners is that they think in terms of structures, not paychecks. They ask questions like, where should this income flow? What entity should own this asset? Which category will this activity fall under? What happens to this 5 years from now? Most everyday taxpayers never think like this because they were never taught to. They're taught to show up, earn a paycheck, and hope the tax bill isn't too painful. But the wealthy reframe every financial decision through a tax lens. One of their most powerful tools is the ability to separate work from compensation. When you work a job, the money you earn is taxed before you ever see it. When you own a business or an entity, you can structure how you take money, as wages, distributions, dividends, rents, or even deferred compensation. Each category is treated differently by the tax code, and wealthy individuals choose the most efficient option. For example, many high earners who operate S corporations pay themselves a reasonable salary that's subject to payroll taxes and then take the remaining profits as distributions, which are not subject to those same payroll taxes. It's a legally approved move, yet many individuals never hear of it because their accountant never suggests changing their entity structure. Another area wealthy people pay close attention to is how expenses are categorized. Regular taxpayers think of expenses as something that only reduces their personal cash flow. Wealthy people think of expenses as opportunities to reassign costs they would have paid anyway into deductible categories. If a cost is going to exist either way, they want the tax code to recognize it. This is why wealthy families often build businesses around things they're passionate about. If they love traveling, they create businesses requiring travel. If they love photography, they form a media company. If they love real estate, they structure their investments so that education, research trips, conferences, and site visits become legitimate business activities. The IRS allows deductions when an expense is ordinary and necessary for a business. Wealthy people make sure their lifestyles align with ordinary and necessary activities. But there's something even more subtle. Wealthy people don't just create businesses, they create ecosystems of businesses. One entity may own intellectual property. Another may handle consulting work, another might hold real estate, and another may own equipment. These entities interact. They rent from each other. They contract services. They pay fees. And all of this happens in a way that's fully legal, but incredibly tax efficient. For example, imagine a high earner who owns a rental property. Instead of owning it personally, they place it in an LLC. That LLC can hire a property management company the high earner also owns. The management company gets paid for its services, which becomes a deductible expense for the rental LLC. Meanwhile, the management company's income may flow through a structure that lets the owner take advantage of different deductions or retirement plans. This kind of internal structure shifts money, spreads income across entities, and opens up categories of write-offs that wouldn't exist if everything sat under the individual's name. Most accountants do not bring these strategies up because their focus is on filing accuracy, not architectural design. Wealthy people treat income like architects treat buildings, carefully designed to support the weight of their ambitions. Another major difference between the average taxpayer and the wealthy is how they treat taxation on investments. Most people invest based on emotion or brand familiarity. Wealthy people invest based on tax efficiency and total return. They care about how much money they keep, not just how much they make. This is why high earners invest heavily in assets with preferential tax treatment: real estate, long-term stocks, index funds, private placements, and tax-advantaged funds. They know that long-term capital gains are taxed at a much lower rate than ordinary income. And they also know that many investments allow them to defer taxes for years or eliminate them completely with strategies like opportunity zones or tax loss harvesting. Tax loss harvesting is a tool wealthy investors use constantly. When their investments dip, they intentionally sell those losing positions to lock in a capital loss. That loss can then offset capital gains, reducing taxes on profitable investments. And if they still want exposure to the asset, they buy a similar one to maintain their strategy while avoiding wash sale rules.
The average taxpayer sees a market dip and panics. Wealthy people see a tax opportunity. But perhaps one of the most powerful, least mentioned strategies high earners use is the splitting of income among family members. This isn't the cliche idea of paying your kids to do chores. It's about legitimately hiring family members in a business. If a business is real and the work is real, paying a family member shifts income from a higher tax bracket to a lower one. And if you pay your children through certain types of businesses, you may avoid payroll taxes entirely. Imagine a high earner paying their child $12,000 through a business for real work: content creation, office assistance, editing, photography, research, or administrative tasks. That $12,000 becomes a deductible expense for the business, reducing taxable income. The child, if under a certain threshold, pays no income tax at all. That's money the family keeps. This is a textbook example of how wealth is preserved through structure, not through luck. Another pillar of high earner tax strategy revolves around deductions regular taxpayers rarely maximize. For example, health savings accounts, also known as HSAs, are often called the triple tax-advantaged account because contributions are deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. Wealthy people use HSAs as stealth retirement vehicles, investing the contributions and letting them grow for decades. Many taxpayers use HSAs like a checking account. Wealthy people use them like an investment account. But perhaps nothing separates wealthy Americans from average taxpayers more than how they treat depreciation and leverage. Let's break this down because it's one of the key tax secrets accountants rarely explain in depth. Depreciation lets you deduct the wear and tear of an asset over time, even if the asset is increasing in value. Real estate is the classic example. A building might be worth more 10 years from now, but the IRS still allows the owner to deduct a portion of its value every year. Wealthy people combine this with cost segregation, which breaks a building into components: walls, fixtures, flooring, systems, so that different parts can be depreciated faster. Accelerated depreciation means huge deductions in the early years of ownership, often enough to offset the rental income entirely. Now add leverage. Leverage means borrowing money to acquire assets. If you buy $1 million building with $200,000 down and financing for the rest, you get to depreciate the whole building, not just the $200,000 you put in. Your accountant may list depreciation on your tax return, but many never explain the strategic advantage behind it. Wealthy people build empires with it. Let's move deeper into an advanced strategy wealthy individuals use: the tax arbitrage between different types of income. This is where the rules get fascinating. Different categories have different tax environments. A wealthy strategist examines all categories available: active, passive, portfolio, business, real estate, and shifts their income into the most favorable categories whenever legally possible. For example, rental real estate generates passive income. Business activities generate active income. Capital gains generate portfolio income. But there are legal methods to reclassify some passive losses to offset active income, especially if someone qualifies as a real estate professional or uses short-term rental strategies. Many taxpayers own rentals but don't realize they're a few adjustments away from unlocking the ability to offset large amounts of income. Wealthy people know the exact criteria, the documentation required, and the timing necessary to make it happen. And that brings us to another tax secret accountants rarely discuss: holistic planning. Wealthy people integrate taxes with their investment strategy, their legal structure, their retirement planning, their estate planning, and even their lifestyle decisions. An accountant looks backwards: what happened last year? A strategist looks forwards: what can we plan for the next decade?
Average taxpayers ask, how much do I owe? Wealthy taxpayers ask, how do I position my life so that taxes become an afterthought? This difference in thinking shapes everything. There is also one more reality wealthy people embrace. The tax code rewards ownership, not labor. When you own assets, you benefit from deductions, leverage, step up in basis, capital gains treatment, and long-term growth. When you earn a wage, you're stuck with the highest tax burden in the system. Wealthy Americans don't rely on wages, they rely on assets.
They build portfolios that grow while they sleep. And those portfolios can be structured to minimize taxes at every stage of the process, from acquisition to holding to distribution to inheritance. And finally, wealthy individuals embrace the idea that taxes are a game with written rules. But most people never read the rule book. They hire people who know how to use those rules. They take courses, they study, they plan, they act intentionally. The average taxpayer views taxes as a one-time event. Wealthy Americans view taxes as a lifelong strategy. This is the part where the tax strategies of wealthy Americans begin to shift from the realm of clever planning into something much more structured, intentional, and, frankly, surprising. Because once you understand the fundamentals of earning differently, owning differently, and timing differently, a whole new layer of strategies opens up. And this layer is where high earners really separate themselves from the average taxpayer. One of the most fundamental principles wealthy Americans understand is that the tax code is far more flexible than most people realize. It's not just a rigid document telling you what you owe. It's a blueprint. And if you know how to interpret it, it tells you exactly how to reduce your taxes, grow your wealth, and position yourself to keep more of what you earn. This shows up in something ordinary taxpayers barely think about: the ability to define how income is characterized. To most people, income is income. But to wealthy individuals, the category of income is a strategic choice, not a fixed fact. For example, wealthy people know that the IRS sees money differently depending on how you receive it. Money you earn from a job is treated one way. Money you receive from a rental property is treated another way. Money you earn as a business owner is treated differently still. Dividends, royalties, long-term gains, short-term gains, carried interests, pass-through income, interest income, and distributions each has its own rulebook. One of the biggest secrets is this: the best tax strategy isn't always to make less money, it's to change the type of money you're making. That's not a secret your accountant usually talks about, because their job focuses on the tax forms, not the categories you choose to plan. High earners are constantly shifting income into categories that produce the lowest tax burden. This is why so many wealthy individuals take extremely low W-2 salaries, even when they run multi-million-dollar companies. They're not trying to be cheap with themselves. They're reallocating the type of money they receive. Another sophisticated strategy wealthy individuals use involves layering income. They break their compensation into multiple streams across different entities. Some income flows as wages, some as dividends, some as distributions, some as rents, some as management fees, some as royalties for intellectual property, some as consulting income. By diversifying the way income shows up, wealthy individuals aren't just earning more, they're allowing the tax code to treat those dollars differently. This leads into something even more nuanced. Wealthy people understand the difference between income and cash flow. To the average person, they're the same thing. But wealthy people know income is what the IRS taxes. Cash flow is what you live on. They structure their lives so that their cash flow comes from sources taxed at favorable rates. For example, borrowing against assets creates cash flow but not taxable income. Distributions from certain partnerships create cash flow but may show losses on paper. Selling appreciated assets after holding them for over a year creates cash flow taxed at a lower rate. And rental real estate often produces cash flow that the IRS sees as neutral or even negative because of depreciation. That's why you'll hear stories about wealthy people showing extremely low taxable income while living extremely well. They're not hiding money. They're using structures the tax code intentionally allows.
One area where wealthy Americans excel is in converting personal expenses into business expenses whenever legally possible. They don't break rules. They align activities with legitimate business functions. Let's take travel as an example. Most people pay for vacations with after-tax dollars. Wealthy people look for opportunities to integrate travel with genuine business activity. They might attend conferences in different states or countries, visit properties or projects, meet with partners or clients, or conduct business research. As long as the primary purpose of the travel is legitimate business, many associated costs become deductible. Another area is vehicles. The tax code includes rules like Section 179 and bonus depreciation that allow large deductions for vehicles used for business purposes. Wealthy Americans often use these rules to offset income while acquiring vehicles they were going to use anyway. The distinction between personal and business expenses becomes clearer when you see how wealthy individuals design their businesses around their actual lives. They integrate their interests, hobbies, and goals into business activities. If they're passionate about something, they're likely to create a business around it, not just for profit, but because the tax code favors business operations. This principle extends into one of the most misunderstood areas of the tax code: losses. Most people assume losses are bad. Wealthy people know losses can be incredibly valuable, especially when they're paper losses. Paper losses are losses that show up on tax returns but don't reflect real financial harm. Depreciation is one example. Writing down the value of assets for taxes purposes, even when those assets are gaining value, creates a loss that offsets income.
Passive losses from real estate can offset passive gains. Active losses from business activities can, in some cases, offset active income. And strategically timed losses can lower tax liability in years with unusually high income. One advanced strategy wealthy individuals use is carry forward and carry back losses. Some losses can be applied retroactively to past tax years or stored for future years. This gives wealthy individuals a way to smooth their taxable income and avoid spikes in liability. But there's an even higher level to all of this. Wealthy individuals leverage the tax code to move income out of their estate entirely. Estate planning is often overlooked by everyday taxpayers because it sounds like something only billionaires think about. But high earners know that estate taxes and inheritance rules can eat a huge portion of generational wealth if not planned for properly. So they take action long before those problems arise. They use trusts to own assets. They use family-limited partnerships to transfer ownership without triggering massive tax bills. They use gifting strategies that move appreciating assets out of their estate before the appreciation occurs. They use charitable trusts not only to donate, but to reduce income taxes today. Most accountants don't initiate these conversations because estate planning is considered a separate service. But wealthy people know taxes don't end at death unless you structure them to. Another area where high earners excel is in using the tax code to influence the timing of liquidity events. This is especially common with business owners, startup founders, and investors. They think carefully about when to sell. They understand that selling too soon creates short-term capital gains, which are taxed at higher rates. They know that waiting at least a year can cut the tax rate significantly. They also know that certain types of stock, like qualified small business stock or QSBS, can allow a founder to sell potentially tens of millions of dollars tax-free if they meet the criteria. This is an area many everyday taxpayers have never even heard of, yet wealthy Americans use it strategically. Another strategy that rarely gets discussed by regular accountants is installment sales. Instead of selling a major asset all at once, high earners structure the sale so that they receive the income over time. This spreads out the tax burden and keeps them out of higher brackets. Wealthy people avoid massive tax spikes by breaking transactions into smaller events. Another advanced move is the use of tax-efficient charitable giving. Wealthy individuals don't just write checks. They donate appreciated assets to avoid capital gains.
They use donor-advised funds to park charitable contributions in a way that gives them an immediate deduction while allowing them to spread out the donations over many years. They donate real estate, cryptocurrencies, equities, and business interests. And in some situations, they use charitable trusts to reduce estate taxes and even increase cash flow in retirement. Another subject many accountants don't discuss is this. Wealthy people almost never file their taxes alone. They build a tax team. This often includes a CPA, a tax strategist, an attorney, a financial planner, an estate planner, a bookkeeper. Why? Because no single professional understands every nuance. Wealthy people assemble expertise the same way they assemble assets. They diversify it. This is a crucial difference. Most taxpayers rely on one person. Wealthy people rely on a team. Wealthy individuals also make taxes a monthly or quarterly conversation, not a once-a-year burden. They regularly review their income, expenses, investments, and restructuring opportunities. They constantly adjust their strategies to match new laws and new opportunities. That's another thing wealthy Americans understand. The tax code changes constantly. What worked last year may not work next year. So they stay updated, they adapt, they plan ahead. But perhaps the clearest divide between wealthy Americans and average taxpayers is this. Wealthy people treat taxes as a controllable variable. Most people treat taxes as an unavoidable fact. Wealthy people see them as something to manage, just like any other financial factor. They don't wait to see what the tax bill is. They build their life around minimizing it. They choose investments based on tax treatment. They choose business structures based on tax flexibility. They choose how they're compensated based on tax levels. They choose how they use debt based on tax advantage. They choose how and when to sell assets based on tax outcomes. And they choose how to pass wealth based on tax laws. And that's why wealthy Americans often have dramatically lower effective tax rates than individuals earning far less money. This is because they don't cheat, not because they hide.
Not because they manipulate, but because they understand a truth that many Americans never learn. The tax code isn't designed to punish income. It's designed to guide behavior. And wealthy individuals behave in ways the tax code rewards. Once you grasp that concept, that the tax code is a behavioral instruction manual disguised as law, you start to see why wealthy Americans play such a different financial game than everyone else. It's not simply about having more money. It's about understanding the rules, the incentives, and the loopholes that aren't really loopholes at all, but rather built-in rewards for engaging in activities that strengthen the economy. By this point, you've seen how wealthy individuals structure their income, their expenses, their investments, and even their lifestyle choices around tax efficiency. But there's still a deeper layer, one that moves beyond the strategies themselves and into the mindset that makes these strategies work. Because the real secret wealthy Americans know is this: tax planning is not about what you do in April. It's about what you do all year long. Every major decision they make, buying real estate, starting a business, investing in something new, hiring people, forming partnerships, is filtered through the question, how does this affect my tax position? Most Americans ask that question once a year. Wealthy Americans ask it every month. Take real estate, for example. To the average person, buying a home is just buying a home. But to wealthy individuals, real estate is a tax engine. It's a way to generate income, build equity, depreciate assets, leverage debt, and pass wealth to the next generation with minimal tax exposure. But they don't randomly buy properties. They're intentional. They choose properties that produce strong cash flow or strong appreciation, or ideally both. They evaluate the potential cost segregation benefits. They consider how the property fits into their broader strategy. And they always look at the tax impact before finalizing any deal.
This intentionality is critical. The average taxpayer reacts to taxes. Wealthy people anticipate them. This proactive mindset shows up again in how high earners treat debt. Regular taxpayers are taught to fear debt. Wealthy Americans see debt as an opportunity, especially when leveraged correctly. Debt allows them to expand their portfolio without triggering taxable events. It lets them borrow against appreciating assets, maintain ownership, avoid selling, and keep their net worth growing. Imagine having a portfolio worth millions, with the ability to borrow at low interest rates against it. That borrowed money isn't taxable. It's essentially tax-free liquidity. Wealthy individuals use that liquidity to invest in more cash flow-producing assets, which then generate even more deductions, more depreciation, and more tax-advantaged growth. Most people think borrowing means being in a worse financial position. Wealthy individuals think borrowing means controlling more assets with less personal capital. Another major distinction is how wealthy Americans treat retirement planning. Regular taxpayers think of retirement accounts as something their employers handle. Wealthy individuals take advantage of retirement vehicles most people don't even know exist. For instance, many high-earning business owners use defined benefit plans, cash balance plans, solo 401ks, SEP IRAs, mega backdoor Roth strategies, and multi-entity retirement structuring. These accounts can allow contributions that dwarf the standard limits most employees are familiar with. Instead of contributing a few $1,000s, wealthy individuals may legally contribute tens of thousands or even hundreds of thousands of dollars into tax-deferred or tax-free accounts each year. But here's the catch. These opportunities only exist if you understand how to structure your business, your income, and your compensation. An average accountant might not suggest forming an S-corp or creating a retirement plan tailored to your income, but a tax strategist will evaluate your entire financial picture and recommend structures that maximize your savings. This brings us to an important point. The wealthiest Americans are not just following tax rules, they're designing their lives to take advantage of them. They don't assume anything. They review the laws, they consult experts, they experiment, they track their strategies, they change course when necessary, and they treat taxes as something that can be shaped rather than endured. You may have noticed something else. Wealthy people don't just use one or two strategies, they stack them. That's another secret accountants often overlook. Take a high earner who owns a business and invests in real estate. They might use bonus depreciation to offset rental income, S-corp structures to reduce payroll taxes, retirement plans to shelter business income, HSAs for triple tax advantages, opportunity zones for capital gains deferral, charitable deductions to reduce taxable income, LLCs to separate assets and protect liability, and trusts to eliminate estate tax exposure.
Each strategy is powerful on its own, but when combined, they create an interconnected system where every dollar is optimized, shielded, or redirected to create more wealth. This layered approach is where wealthy Americans thrive. They don't rely on a single trick. They build a network of strategies that work together. To the average taxpayer, this might seem overwhelming, but wealthy individuals don't start with everything at once. They build their tax system step by step. First, a business structure, then a retirement plan, then real estate, then advanced strategies like trusts or charitable planning. Over time, their structure becomes nearly self-sustaining. Another often overlooked advantage wealthy Americans have is the way they document everything. The IRS doesn't just care about the numbers, they care about proof. Wealthy individuals understand the importance of documentation because documentation is what turns a questionable deduction into a bulletproof deduction. Every expense, every trip, every purchase, every business activity, they keep records, they maintain logs, they track mileage, they store receipts properly, they keep detailed notes, they use software, they hire bookkeepers. Many accountants never emphasize this because it's not glamorous, but wealthy people know that robust documentation transforms the tax code from something risky into something predictable.
Next, let's talk about something that separates high-income earners from everyday taxpayers more than almost anything else. Wealthy Americans understand that taxes affect every major financial decision, even when the connection isn't obvious. When they choose a place to live, they consider state taxes. When they choose an investment, they consider its tax efficiency. When they choose a business partner, they consider how income will flow. When they choose to sell something, they consider the tax year. When they get married or divorced, they consider how tax brackets will shift. When they buy or sell real estate, they consider depreciation recapture. When they borrow money, they consider interest deductibility. When they hire employees, they consider payroll taxes and credits. When they start a new business, they consider how it aligns with their existing entities. Taxes are not a separate category for wealthy Americans. They are woven into every financial move they make. Another powerful insight wealthy people embrace is this: tax laws are written with winners and losers. Every deduction, credit, and incentive creates an advantage for someone and a disadvantage for someone else. Wealthy individuals make sure they're on the side that benefits. But nothing shows this more clearly than how high earners respond to new tax laws. When the average taxpayer hears about tax changes, they panic. Wealthy individuals adapt. They adjust their structures, shift their strategies, and move assets or incorporate new entities. They meet with their advisors, they rerun the numbers, they redesign their approach. And as tax codes evolve, wealthy Americans evolve with them. That's why they stay ahead. One key area where high-income Americans excel is in understanding the importance of separation. They separate personal from business. They separate properties into different entities. They separate operating income from intellectual property. They separate high-risk assets from low-risk assets. They separate long-term holdings from short-term ventures. They separate depreciating assets from appreciating ones. This separation creates clarity, protection, and tax efficiency. It also helps them weather economic storms. Another fascinating strategy wealthy people use is income smoothing. Income smoothing is the intentional spreading out of income and deductions to keep tax rates low. Instead of having one year with very high income and one with very low, which can lead to higher taxes, they strategically plan when income is recognized and when deductions are taken. A business owner might accelerate expenses into a high-income year to reduce taxes, or they might delay invoicing until the following year if they expect to be in a lower bracket. They might sell investments one year and harvest losses the next. They constantly adjust. The average taxpayer doesn't have this flexibility because they operate in a world of fixed income and minimal deductions. But wealthy Americans create flexibility through entity structures, investments, and planning. Another concept wealthy individuals master is tax-free growth. They rarely put money into taxable accounts unless they have a strategic reason. They funnel money into accounts with preferential treatment. They invest in assets that grow without tax friction. They reinvest dividends. They borrow against assets instead of selling them, avoiding taxable events. This is why net worth among wealthy individuals compounds so quickly, because they eliminate the drag caused by taxation. Finally, there's the concept of exit strategy planning, something wealthy Americans prepare for years in advance. Whether they're selling a business, transferring assets to their children, retiring, or relocating to another state, they think carefully about the tax implications long before anything happens.
This planning might involve relocating to a tax-friendly state, moving assets into trusts, using installment sales, donating appreciated assets, deferring capital gains, leveraging QSBS rules, restructuring business ownership, creating buyout plans. All of these strategies allow wealthy individuals to control how much tax they pay when they leave an investment or transition into a new life stage. Most taxpayers think exit planning is for retirees. Wealthy Americans treat exit planning as a normal part of every financial transaction. And all of this leads to one conclusion. Wealthy Americans don't just play the tax game, they design it around themselves. If you've ever wondered why some high-earning Americans seem almost unfazed by tax season while everyone else is scrambling, you're about to see the final layer of the strategy, the part almost nobody talks about openly, because it reveals how the wealthy treat taxes like a long-term game rather than a yearly bill. At this level, taxes aren't just something to pay, minimize, or defer.
They become something to engineer, coordinate, and even negotiate indirectly through how you shape your financial life years in advance. And while most people only interact with the tax system once a year, high earners interact with it constantly, quietly, and strategically, making micro adjustments that compound in ways that seem almost invisible to everyone else. One of the most misunderstood advantages high-earning Americans rely on is the idea that the tax code rewards behavior more than income. Most taxpayers assume taxes punish you for making more. Wealthy people see the opposite. Taxes reward you for building, for investing, for providing value and taking calculated risks. And the moment you understand that, the way you approach every financial decision changes dramatically. Because once you realize the tax code is basically a giant incentive manual written by policymakers who want to encourage certain behaviors, you start making decisions that fall into the incentive categories rather than the penalty categories. And yes, those incentives apply to everyone, not just the ultra-rich. A major part of this final stage is learning that wealthy Americans often have tax seasons inside the year. Internal checkpoints where they revise income flows, adjust spending categories, increase or decrease contributions, and reposition assets. It might happen quarterly, monthly, or every few weeks depending on complexity. Most people wait until April when it's too late to fix anything. But high earners treat taxes the same way athletes treat conditioning, a constant process, not a once-a-year event. And because of that, they capture benefits most people never even know they missed. Let me give you an example that is both simple and profound. Deduction stacking. Most people claim deductions when they occur, without any coordination, without a timing strategy. High earners often cluster deductions strategically in specific years to tip themselves into a higher benefit bracket. This could mean timing charitable contributions, bunching medical expenses, accelerating certain business costs, or deferring others, all to hit targeted thresholds where deductions suddenly become far more valuable. Most middle-income households, even highly educated ones, never consider this because they assume all deductions behave the same. But many deductions have thresholds, cliffs, and phase-outs that change their value dramatically depending on timing. And this brings up something else wealthy Americans do exceptionally well. They understand the rhythm of tax law. Tax laws don't change randomly. They follow cycles, policy cycles, economic cycles, election cycles. High earners monitor these cycles and position themselves based on probabilities. If lawmakers are signaling a change to capital gains taxes, high earners might harvest gains early or shift assets into structures that offer protection. If there are upcoming incentives for clean energy, commercial development, or technological innovation, they move quickly, often capturing benefits before the general public even hears about them. To most people, it looks like perfect timing. It's not. It's structured awareness. Another tax secret, and this one is huge, is something many accountants don't actively teach because it requires long-term planning, not just yearly filing. Wealthy Americans use every dollar twice. And I don't mean that figuratively. The tax code allows certain dollars to serve multiple purposes at once. A dollar contributed to a certain type of retirement plan can reduce taxable income today, grow tax deferred, and allow strategic withdrawals later. A dollar spent by an S-corp owner on a necessary business expense can reduce business income, protect personal income, and lower overall tax liability while serving a functional purpose in the business. A dollar placed into the right kind of trust can protect assets, reduce tax exposure, and pass wealth efficiently to future generations. This concept, using dollars multiple times, is one of the greatest differences between middle-income tax planning and high-income tax engineering. Middle-income households spend dollars once. High-income households design dollars for multi-purpose functionality. Then there's the layer of negotiation, not in the sense of arguing with the IRS, but in shaping your financial life so that the IRS offers you better options. Wealthy Americans know that certain actions open doors to different tax methods or categories. For example, some income is taxed at ordinary rates, some at capital gains rates, some is excluded, and some is deferred. The moment you can legally reclassify income, restructure income sources, or shift where income originates, the entire tax picture changes. This isn't about hiding money, it's about understanding how the system categorizes money.
One of the tools wealthy Americans use for this purpose is restructuring how they earn. Instead of relying purely on W-2 income, the most heavily taxed form of income, they create or utilize other income types. Business income, dividend income, interest income, passive income, rental income, capital gains. Each category follows different rules, different rates, and different incentives. And once you diversify the types of income you earn, you gain access to strategies that simply don't exist within a single income category. This is part of why the wealthy are huge fans of owning businesses, even small ones. Business ownership unlocks a wider range of deductions, credits, and structural options. It lets you separate personal and business expenses clearly, convert certain costs into legitimate business deductions, and reduce how much income is taxed at the highest bracket. You don't have to run a large company. Sometimes even a small consulting business or side venture opens the door to options that W-2 income simply cannot provide. But even more interesting is how high-earning Americans use coordination, layering multiple strategies to create compounding effects. They don't just reduce their income tax. They combine reduced income tax with tax-advantaged growth, with tax-efficient spending, with tax-optimized timing, with legal income reclassification, with entity structuring, with estate planning. Each layer builds on the other. Most accountants only handle a slice of this. Wealthy people assemble a whole system. And one of the most underestimated elements of that system is timing. Timing isn't just about when you pay taxes. It's about when you recognize income, when you incur expenses, when you take gains, when you take losses, when you contribute to retirement accounts, and when you shift investments. Wealthy Americans use timing to build tax rhythms that sync with their financial goals. Recognize income in lower income years. Harvest losses in high income years. Delay recognizing certain gains when policy changes might make waiting beneficial. Pull forward certain expenses before a major shift in tax brackets. It sounds complicated, but high earners treat it like tuning an instrument. Constant, small adjustments that create harmony over time. There's something else too, something subtle but extremely powerful. High earners use what I call tax positioning through lifestyle design. This means they align where they live, how they work, how they travel, how they invest, and how they structure daily life in ways that naturally produce tax benefits. For example, living in a state with no income tax, or living in a state where taxes are high but deductions are plentiful for certain professions, or choosing to operate remotely so travel expenses become deductible under specific business frameworks, or designing a home office that legitimately qualifies for deductions, or choosing systems that track, categorize, and optimize spending automatically without needing constant attention. Wealthy Americans build lifestyles that are tax-compatible from the ground up. And one more thing. The wealthy understand the game, but they also understand the consequences of playing it poorly. They don't take reckless shortcuts. They don't hide income. They don't play games that collapse under audit. They follow the rules, sometimes better than the people who created them. Because the true power of tax strategy is not in breaking the rules, it's in mastering them. When you look closely, you start to see the deeper truth. The US tax system isn't built to trap people. It's built to reward certain behaviors. And if you model your decisions around those behaviors, whether you earn $50,000 or $500,000, you can unlock far more benefits than you might think. The difference isn't access. The difference is awareness. And at this final point in the journey, something becomes clear. High-earning Americans don't just reduce taxes. They build lives where taxes play a specific, predictable, manageable role. Their taxes aren't random. They aren't overwhelming. They aren't frightening. They're designed. Not in the sense of complete control, but in the sense of alignment. Alignment with their goals, with the incentives in the tax code, and with the strategies that keep wealth growing year after year. And that's where this entire exploration leads, to the understanding that tax strategy isn't about what you earn. It's about how you structure, categorize, time, and coordinate what you earn. It's a system, one that becomes more powerful the earlier you start using it, one that gives you more control the more you understand how the incentives work, and one that becomes clearer the moment you stop treating taxes as a necessary evil and start seeing them as a guidebook. Consult a licensed tax professional before making any financial decisions. This video is for educational purposes only. Thank you for watching.